If you typed how to grow your net worth fast in 1 year into YouTube, you got back a list of videos that promised you something close to $100,000 of net worth growth in 12 months, sometimes more. Side hustles, stock picks, crypto, real estate flipping. The numbers in the thumbnails are big and the promises are bigger. I want to do something different in this video, which is tell you the actual math of how much net worth growth is realistic in 12 months for someone earning a normal salary, and then walk through the 5 specific moves that produce that real number. The number is meaningful. It's just not the number the thumbnails are selling you. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. I want to acknowledge up front that fast is a word I usually try to avoid on this channel. Wealth doesn't actually happen fast for normal people, but 12 months is a real window of time, and what you do inside that window does compound for the next 30 years. So it's worth asking honestly what's possible inside that window. The answer is going to be smaller than the YouTube thumbnails promise and bigger than most people think it is. And I think that range is the most useful thing I can give you in this video. Let me start with the honest answer that no other video on this topic will give you up front. For someone earning between $70,000 and $100,000, with a typical financial starting point that includes some debt, modest savings, and a normal mortgage, the realistic net worth growth available in a single year through legal, sustainable moves is somewhere between $25,000 and $40,000. The high end of that range requires you to execute most of the 5 moves I'm going to walk through, and to catch a reasonable market year on whatever you already have invested. The low end is what happens if you pick the 2 or 3 moves that are easiest for your specific situation and execute them properly. That number is going to feel small compared to the YouTube thumbnails. I want to put it in context. Per multiple longitudinal studies on household wealth changes, the median US family adds something between $5,000 and $15,000 to their net worth in a typical year, with significant variation depending on the market and the household. So $25,000 to $40,000 in a single year, deliberately produced through specific moves, is genuinely top decile financial performance for someone at a normal income. The reason you don't see it discussed honestly is that you can hit the top decile of net worth growth this year is a less exciting thumbnail than I made $100,000 in 12 months. The math is unsexy. The math is also the truth. Move 1. The savings rate raise. The single highest leverage move available to most people in a given year is to push their savings rate up by a meaningful number of percentage points. Not by 1%, which is invisible, and not by 20%, which is unsustainable for most. The realistic target is something like 5 to 10 percentage points, which produces a real change in net worth without requiring you to abandon your life. Here's the math for an $80,000 earner. If you've been saving 8% of your gross income, you're putting away about $6,400 a year, which is roughly $533 a month. If you push that to 18% over the next 12 months, you're putting away $14,400, which is $1,200 a month. The difference is $8,000 of additional savings over the year. That $8,000 goes directly to net worth, with no investment risk, no luck, no market dependency. It's just money that used to leave your life and now stays. The reason a 10 percentage point raise is the realistic ceiling and not 20 is that your fixed costs don't usually compress that fast. You can renegotiate your phone bill, switch insurance, cut subscriptions, and reduce restaurant spending by some meaningful amount, but you can't refinance your mortgage in a month or move out of your lease in 2 weeks. The variable costs that are actually under your control in a 1-year window represent maybe 8 to 12% of a typical household income. Push them as hard as you can, and you'll get most of the way to a 10-point increase. Push harder, and you'll start hitting fixed costs that take longer than a year to change. The mistake most people make on this move is trying to do it all at once and quitting in 3 weeks. The version that actually works is to find a single recurring expense each week and cut it. The first week, the $80 a month cable package goes. The second week, you switch to a different car insurance carrier and save $40 a month. The third week, you cancel 2 of the 4 streaming services. By the end of 3 months, you've taken about $400 a month out of your fixed cost structure without making any single decision that felt painful. That's $4,800 over the next year, just from the fixed cost compression. Add some discipline on the variable side, and the rest of the path to $8,000 of additional savings becomes mechanical. Move 2. Eliminate high-interest debt completely. If you carry credit card debt, the second move is to eliminate it within 12 months. This is mathematically the most powerful move available to anyone who has it, because high-interest debt eats your net worth from 2 directions simultaneously. The principal sits as a negative number on your balance sheet, and the interest you pay on it is wealth that disappears every month. The math here is brutal in your favor when you eliminate it. A $10,000 credit card balance at 22% APR, which is roughly the most recent Federal Reserve average for credit card accounts that are actually being charged interest, costs you about $2,200 in interest over the year if you only make minimum payments. If you eliminate that debt over 12 months by aggressively paying it down, your net worth swings by the full $10,000 plus the avoided interest, which is somewhere around $11,000 of total improvement. None of that requires investment returns or the market cooperating. It is the rare financial move that produces guaranteed returns at a rate that's higher than what the stock market historically returns. I had a friend named Tony who walked into 2024 with $11,000 of credit card debt across 2 cards, both at over 22% APR. Tony worked in IT for a regional insurance company in Pennsylvania, earning about $90,000. He decided that 2024 was the year the debt was going to be gone, set up automatic payments of $950 a month, and just lived around them. The debt was eliminated in 11 months. By the time he sat down with me at the end of the year, his net worth had moved by about $13,000 from that one decision, between the principal he'd paid down and the interest he'd avoided. He hadn't earned more, hadn't gotten lucky, hadn't taken on any risk. He'd just routed his existing income to the highest return target available to him. That's the move. The version of this that doesn't work is paying down the debt while continuing to use the card. The balance stays the same, your monthly payments feel pointless, and you end the year roughly where you started. The version that works requires both the aggressive paydown and a temporary discipline around not adding new charges to the card while you're paying it down. 12 months is not a long time to live without the card. The wealth you build by eliminating the debt is a long time to enjoy. Move 3. Capture every dollar of free money on the table. The third move is the one that almost nobody actually maxes out, and it costs you nothing to fix. Per Vanguard's 2024 How America Saves report, about 21% of employees who have access to a 401k employer match contribute below the level needed to capture it fully. The dollar amount that gets left behind, for someone earning $80,000 with a typical 50% match up to 6% structure, is about $2,400 a year. That's free money. That's the company offering to deposit $2,400 into your retirement account, conditional on you contributing $4,800 of your own. And 1 in 5 people walks past it. If you're in that group, this move is the easiest $2,400 of net worth growth you'll ever earn in 12 months. You log into your 401k provider, Raise your contribution percentage from whatever it currently is to at least the level that captures the full match, and the next paycheck reflects the change. The total time investment is 15 minutes. The annual return is $2,400 in employer contributions, plus whatever those contributions earn in the market, plus the tax savings on your own increased contribution, which at a 22% marginal rate is another $1,000 or so. The combined effect is somewhere around $3,500 of net worth improvement in the year. The reason this move gets ignored is that it doesn't feel exciting. There's no decision to optimize, no fund to research, no strategy to discuss with your spouse. It's just an administrative form change that produces guaranteed returns. The boring administrative form change is the move. The reason wealthy people are wealthy is that they make these moves immediately when they're available, instead of saving them for some future moment of inspiration that never comes. Move 4. Use the tax-advantaged accounts you already have access to. The fourth move is to actually fill the tax-advantaged buckets the IRS makes available to you, which most people leave half empty. The two highest impact accounts for a normal earner are the health savings account, if you have access to one through a high-deductible health plan, and the Roth IRA. Both have specific 2026 contribution limits, and using them produces direct net worth improvement in a single year. The HSA contribution limit in 2026 is $4,400 for individual coverage and $8,750 for family coverage. Every dollar you contribute is deducted from your taxable income, which at a 22% marginal rate means a $4,400 contribution produces about $970 of tax savings in the year you make it. The contributed amount itself stays on your balance sheet, just in a different account. So a $4,400 HSA contribution produces $4,400 of asset growth plus $970 of tax bill reduction for a combined net worth swing of about $5,400 in the year. The HSA is also the only account in the US tax code that's triple tax advantaged, meaning the contributions are tax deductible, the growth is tax-free, and the withdrawals are tax-free for qualified medical expenses. The Roth IRA limit in 2026 is $7,500 for people under 50 and $8,600 for people 50 and over. Roth contributions don't reduce your current year taxable income, but they grow tax-free for the rest of your life. The year one impact on your net worth is just the $7,500 you contribute, but the long-term impact is enormous because that money never gets taxed again. People who systematically max their Roth IRA every year end up with hundreds of thousands of dollars of tax-free retirement income that other people never get. If you can fund both the HSA and the Roth IRA in the same year, you've moved roughly $11,900 into tax-advantaged accounts and produced about $970 in immediate tax savings, for a combined net worth improvement of around $12,900 in the year. That's a meaningful chunk of the $25,000 to $40,000 target by itself. Move 5. Right-size one major fixed cost. The last move is the one that produces the largest single number, but is also the hardest to execute because it requires you to make one big decision instead of a series of small ones. Specifically, this is the move where you look at the two largest line items in your monthly budget, which for almost everyone are housing and transportation, and you decide whether the size of either of them is actually appropriate for where you are financially. The transportation version is the easier one for most people to execute. Per Experian's State of the Automotive Finance Market report from late 2025, the average new car payment in the US is about $767 a month, and the average used car payment is about $537. If you're carrying a new car payment because of a decision you made 2 or 3 years ago, and you trade into a reliable used vehicle in roughly the same category, you can typically reduce the payment by $200 to $300 a month, which is $2,400 to $3,600 a year. You also typically reduce the depreciation hit because used cars depreciate at a slower percentage rate than new cars do. The combined effect of a thoughtful car downsize, including both payment reduction and depreciation savings, is somewhere around $5,000 to $7,000 of net worth improvement in 12 months. The housing version is harder because moving is genuinely disruptive, and most people are correctly unwilling to move every year. But for people who are open to it, downsizing housing in a meaningful way produces the largest single move net worth improvement available in any 12-month window. A $400 monthly housing payment reduction is $4,800 a year, sustained for as long as you live in the new place. A 1% reduction in your mortgage rate, achievable through refinancing if rates have moved in your favor, can save $2,000 to $4,000 a year on a typical mortgage balance. I want to be honest about this move. Most people won't execute the housing version, and that's reasonable. The goal here isn't to ask you to upend your life for a one-year financial improvement, but to make sure that if you have an oversized fixed cost that doesn't actually serve your life, you're aware of what eliminating it would do for your net worth. For some viewers, that calculation will be revealing. For others, the answer will be that the fixed cost is appropriate and the move doesn't apply. Either is a legitimate result of running the math honestly, adding up what's actually possible. Now let me put the 5 moves together for a typical 40-year-old earning $80,000 with $50,000 already invested. Move 1. The savings rate, raised from 8 to 18%, adds $8,000 of net worth. Move 2. Eliminating $10,000 of credit card debt adds about $11,000 of net worth swing, including avoided interest. Move 3. Capturing the full employer match adds about $3,500 of combined match plus tax savings. Move 4. Filling the HSA and Roth IRA adds about $12,900 of tax advantage contributions plus tax savings. Move 5. Downsizing the car adds another $5,000. The 5 moves combined produce about $40,400 of net worth improvement in 12 months. Add a normal market year on the $50,000 already invested, which at a long-term average of 7% real returns adds another $3,500, and the combined number is about $43,900. That's the realistic top of the range for someone in this situation. It assumes you execute all 5 moves, which is genuinely difficult, and that the market does roughly what it does on average, which is not guaranteed in any single year. The lower end of the realistic range is what happens when you pick 3 of the 5 moves and execute them well, which produces something closer to $25,000 of net worth improvement. The reason this number doesn't match the YouTube thumbnails is that the YouTube thumbnails are usually showing you someone who already had $500,000 invested, caught a 30% bull market year, and is reporting their portfolio gain as if it were a wealth building strategy. The wealth building strategy is the 5 moves above. The market gains on existing assets are a separate variable that you can't control and shouldn't take credit for. Most of the videos you've seen on this topic conflate the two, which is what produces the unrealistic numbers. If you're earning $40,000 instead of $80,000, the realistic range scales down proportionally to roughly $12,000 to $20,000 of net worth growth. At $150,000, it scales up to roughly $50,000 to $75,000 of growth, but only if you actually execute the moves. Higher income doesn't automatically produce higher net worth growth. It produces higher possible net worth growth conditional on the savings rate and the discipline. Plenty of $200,000 earners produce $5,000 of net worth growth in a year because they've allowed lifestyle inflation to consume the income. The point of running this exercise honestly is to give you a realistic target. $25,000 to $40,000 in a single year on a normal income is genuinely good performance. It puts you in the top decile of your demographic for that year. It is not $100,000, and the reason it's not $100,000 is that the math doesn't support $100,000 without inputs that most people don't have. The $100,000 promise is what other channels sell. The realistic number is what actually moves your life over time. The 5 moves stack. None of them depend on luck. All of them require some amount of action this month, this paycheck, this quarter. The 12-month window is going to pass whether or not you use it. Pick 2 or 3 of the moves that fit your specific situation, execute them properly, and check your net worth at the end of the year. The number will surprise most of you in a good direction. Drop a comment with which of the 5 moves you're going to execute in the next 30 days. I read every comment and I'll reply to as many as I can. And if you want me to walk through how to compound this 12-month exercise into a 10-year wealth plan, which is where the real numbers actually live, hit subscribe because that's the next video. I'll see you in the next one.